Hi everybody. Welcome back to our series of study guide videos for exam number 2. In this study guide, we will answer questions about question number 7. Recent financial data shown in thousands of dollars for Harmony Health Foods, HHF, Harmony Health Foods, Inc., is shown below. Calculate HHF's debt-to-equity ratio. Again, pause the video, go take a look at your textbook to find the debt-to-equity ratio, then complete the calculation. That's totally legal. Now, if you were taking an exam in class, it wouldn't be legal, but for these questions on the study guides, go for it. The debt-to-equity ratio is 1.13. It's calculated as total liabilities divided by shareholders' equity. Total liabilities are $540,000, and total shareholders' equity is $480,000. $540 divided by 480 equals 1.125, and that rounds to 1.13 when expressed in 2 decimal places. Number 7B. Please pause your video and calculate HHF's times interest earned ratio. Please round your answer to 2 decimal places. The times interest earned ratio is calculated as income before interest and taxes divided by interest expense. The income before interest and taxes is $125,000, and the interest expense is $36,000. So 125 divided by 36 equals 3.4722, which rounds to 3.47. Let's take another bonus break. The scavenger hunt words for this video are a summer afternoon, a summer, S-U-M-M-E-R, afternoon. Going back to 7C, assuming HHF's total assets at the end of the prior year were $960,000, calculate HHF's asset turnover ratio. Round your answer to 1 decimal place. Please pause the video to do your calculation, then start the video again to check your work. The asset turnover ratio is calculated as net sales divided by average total assets. Average total assets are beginning plus ending divided by 2. And last year's ending balance of total assets is this year's beginning balance of total assets. So 960 is the beginning total assets, plus $1,020,000 of ending total assets, divided by 2 equals $990,000 of average total assets. net sales are $350,000 divided by 990,000 of average total assets equals 0.3535, etc. And that rounds to 0.4 if we are rounding to 1 decimal place. Number 7D. Assuming HHF's accounts receivable net at the end of the prior year was $26,000. Calculate HHF's receivables turnover ratio. Round your answer to 1 decimal place. Please pause the video to do your calculations, then start the video again to check your answer. The receivables turnover ratio is calculated by dividing net sales by average accounts receivable net. So we need to calculate the average accounts receivable net. That's beginning receivables plus ending receivables divided by 2. The beginning receivables are $26,000. The ending receivables are $48,000. 26 plus 48 divided by 2 equals average receivables throughout the year of $37,000. Net sales of $350,000 divided by $37,000 equals 9.4594, etc. And that rounds to a turnover of receivables of 9.5 times during the year. That's a little slower than turning your receivables or collecting them within 30 days or 1 month. It's not a bad collection time. So 7E, let's go ahead and calculate HHF's average collection period. Round your answer to 1 decimal place. The average collection period is equal to 365 days in a year divided by the receivables turnover ratio that we already calculated in number 7D above. So 365 divided by 9.5 average turnover ratio equals 38.4211, or a collection of the receivables every 38.4 days. A little slower than once every 30 days, as we kind of predicted up here. But still not bad. Number 7F. Assuming HHF's inventory at the end of the prior year was $16,000, calculate HHF's inventory turnover ratio. Round your answer to 1 decimal place. The inventory turnover ratio equals cost of goods sold divided by average inventory. We're given cost of goods sold in our little financial statement here, but we need to calculate average inventory. Average inventory is beginning inventory of $16,000 plus ending inventory of $12,000 divided by 2. So average inventory is $14,000. Cost of goods sold was $140,000 divided by 14 means that our inventory turnover is 10 times. We turned our inventory over 10 times per year. That's selling it pretty quickly. Number 7G, calculate HHF's profit margin on sales. Express your answer as a percentage rounded to 1 decimal place. Please do the calculations while the video is paused, then start the video again to check your work. Profit margin on sales is calculated by dividing net income by net sales. Net income is $62,000. Net sales are $350,000. That equals 0.17714. Expressed as a percentage rounded to 1 decimal place would be 17.7%. Now calculate HHF's return on assets. Express your answer as a percentage rounded to 1 decimal place. Assuming HHF's shareholders' equity was $420,000 at the end of last year, calculate HHF's return on equity. Express your answer as a percentage rounded to 1 decimal place. Return on equity is calculated by dividing net income by average shareholders' equity. So we have to calculate average shareholders' equity. That calculation is beginning shareholders' equity plus ending shareholders' equity divided by 2. Last year's ending balance of equity is this year's beginning balance of equity. So beginning shareholders' equity is $420,000. The ending shareholders' equity is $480,000. $420 plus 480 divided by 2 is average shareholders' equity of $450,000. Net income of $62,000 divided by $450,000 equals 0.13778, which rounds to 13.8%. Well, that's all for this video. See you next time.